All right, looks like we're live. Welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker DISCA Discovery. Although this valuation applies just about as equally to the B shares for the company, which is DISCB, and who knows, by the time people are watching this, it could have already switched over to its new ticker, WBD, though that's also in the title. So whatever. The company Discovery is expected to be closing in spin-off acquisition with the other company, at&t, which is a holding of ours. They are spinning off the Warner Media section of their company to be then combined with Discovery, which is forming Warner Bros Discovery, which is going to turn itself into a pretty large entertainment giant, at least definitely relative to what Discovery was previously. They're going to be the surviving corporate name. Overall, they're combining the names obviously, but it's Discovery that's technically the surviving overall company, even though they're technically combining with a company that's 3 times or 4 times their revenues, which is pretty interesting. So we're going to go over that, and definitely have covered this company several times on the channel before. As we've approached the deal, I'm kind of approaching how I'm doing the valuation a little bit differently, but in some ways a little bit the same. I did a lot of prep work, kind of trying to figure out how I wanted to translate that into my my spreadsheet template. Hey, how's it going? Yeah, Comcast, another big entertainment giant, though I've never really seen a huge amount of things that drew my attention to it. I don't know if they're trading super cheap right now and that's why you're mentioning them or something, but another big one for sure. One moment while I page over real quick. Next time, well, I'll take a look at them. Let's see what they look like. But yeah, so as with it shows on this little chart right here, this is kind of the overall picture of what's going to happen. at&t is splitting off all the assets of Warner Media to become at&t, with Warner Media coming over here along with $43 billion of their debt. Discovery shareholders combining with that to make the new company. 100% of Discovery, along with 29% of Warner Media going to Discovery shareholders and 71% of it going to at&t shareholder. Though with that's an extension of $43 billion of debt. Though again, that is also on top of the fact that they already have a decent amount of debt. But in fact, they're already at a pretty high debt to equity ratio. Though depending on what happens with the stock relative to everything in action as the close of this deal, that may improve their debt to equity ratio rather dramatically, which we'll get into. It all kind of depends on what happens with the market cap. The market cap of both at&t and Discovery have come down significantly since the deal has been announced, but whether or not that's actually going to be all of the decline, or if there's going to be further declines when the deal goes through, is the question. Because I could imagine a decent amount of the at&t shareholders are going to sell their shares once they get their share of the company, depending on what happens. A decent amount of them will probably keep holding, and I imagine the Discovery shareholders for the most part will keep holding since they're currently holding. But there's a decent amount of at&t shareholders that'll probably look at those extra shares as just a quick payoff, and they only want to own at&t. Although there's other people that will be going the opposite direction with that and only want to own Warner Brothers Discovery and don't want to own the telecom. But the overall trade-off is that I could see once the deal goes through, there's going to be further market cap drops, and that all just depends on the overall net desires of all the shareholders combined. But basically, whatever happens to that on the overall net decides what's going to happen to the debt to equity ratio, which has a huge dramatic effect on the ending valuation, as we'll get to. Well, maybe if you say so, but that depends on if you actually want to own the stuff that Comcast owns. They don't really have very attractive assets, in my opinion. So they might be trading cheap, but what are you getting for that cheapness is the question. I think Warner Brother properties is pretty reasonably valuable properties. And I also thought AT&T's networks was pretty strong. Comcast has strong networks, but the content part of their business I don't think is super strong. So I don't know. They are trading cheap though, so it all depends on what it's worth. Like I said, I've been an AT&T shareholder for quite a decent amount of time. They haven't been a very great investment for me in that period of time, though they haven't been a very large portion of my portfolio either. But this deal was interesting to me partially just because I did see it as an opportunity for the value to unlock. I mean, the real question for Comcast is whether or not they maybe want to sell their entertainment part of their business to one of the other bigger players as well. But I don't know. Like I said, I'll take a look at them. No guarantees that I actually do a stream though, because I haven't seen whether or not they're of interest exactly. But I'll take a look at them and see if they're of interest. But anyway, getting back to Warner Bros Discovery. So anyway, this chart basically spells out the overall plan for the valuation, though how we're going to translate that into the spreadsheet is a little bit strange. Based off the fact that, as they said, 71% of the shares are supposed to be going to AT&T, I kind of have to make an adjustment to the expected amount of total diluted shares that they're going to have at the close of the deal. And based off that, I use all of the diluted share count that they report, as well as the diluted effects of their preferred securities, which they don't include in their diluted share count, which actually means that my diluted share count prior to the deal is actually like 150 million shares larger than the diluted share count they're including. I could be going at that wrong, but for full conservative sake, I'm going to include those and assume that those preferred shares are turned into they're convertible preferred shares. I assume that they convert into common shares before the deal closes. So if that's true, then the total share count that we should end up with, based off of the current share ratio that they're at now, would get us somewhere in the vicinity of 2.3 billion shares. And if their share price isn't going to change, then that would get us a market cap of 65.7 total diluted $billion, which is a huge increase in market cap relative to where they currently are. But again, that's assuming that the share price doesn't change. I could easily see the share price dropping 25-30% when the deal closes. Like, it wouldn't surprise me at all if it crashed as soon as the deal closes, which would be an adjustment of the market cap possibly to where it ought to be. But it's worth noting that the revenues are going to jump dramatically with that. The Discovery had $12.1 billion in revenues in the most recent year, and they're going to be taking on approximately $35 billion in revenues based off of the 2021 numbers that Warner Media did. So if that gets us a pro forma number of $47.8 or so billion, and so $65.7 billion market cap actually isn't that outrageous if you think of it as a market cap to revenue type number. Though obviously, if you include the total enterprise value, which is the correct thing to do, generally speaking, when you're talking about scaling to revenues, it still makes it larger. But that either way, that gets us to like an EV to sales of maybe like 3, which is pretty reasonable. So $65 billion market cap, it's also possible that it doesn't drop at all, is basically the point I'm trying to make. It's hard to tell what will happen. I could see it dropping dramatically because a lot of people sell out of it, but I could also see it coming back up to that market cap strictly on an EV to sales basis. But EV to sales obviously isn't proper valuation. So either way, we are using these sort of expectations of where the revenue is likely to go, which gets us to our expectations for what we're going to be projecting. But I'll get into that after I do all the numbers. I actually did put in a lot of the projection numbers already. I normally do that after I run the numbers, but I kind of wanted to put in my projections based off of the post-close information that they provided us, rather than based off of the historical numbers, because obviously the historical numbers are just Discovery, so it doesn't really have anything to do with that. So the other prep work that I have done though is I did do the normal segmentation based off of the most recent year, but I also did include the way I do the segmentation off of my AT&T valuation for Warner Media, and I included it in here, and that gets us to an unlevered beta of 0.99, though they do have a huge amount of debt, so that's going to be interesting to see what that levers up to with the full market cap though. That's technically going to, like I said, that's going to give them a huge bonus to their debt to equity ratio, just because their market cap has dramatically increased. So that's one little bonus they're going to get. The sales to capital ratio for the industry that we compute them to be participating in is really high at 2.17, mostly because a huge portion of the revenues comes from advertisement sales, and a net revenue of 12.45. I do know that they are low in both of those categories. They have a pretty low sales to capital ratio, but that's mostly because they actually have a sales to capital ratio that's closer to the broadcasting and cable television side of their business more than the advertising side of the business. So these numbers are not actually going to be super useful for us for the most part. We're just going to have to use our own expectations, which, like I said, I'm using also some of the other information in their the post deal presentation that they gave us to kind of calculate what I think we're going to do for capital expenditures, but I'll explain that when we get there. So as it currently stands, they have $16 billion in debt, 14-year weighted average maturity, and about a 4% interest rate. If we calculate the new debt, that gets us to a total amount of debt of about $59 billion, which if we compare that to the market cap, that gets us an 89 to 90% debt to equity ratio, which is basically what I was talking about. And that's relative to their current debt to equity ratio, which I'm pretty sure is more like 110, 120%. So yeah, it's a pretty decent improvement to the debt to equity ratio just by where the current market cap would suggest that they would be. Though, like I said, there's some conservative estimation in there, and also we'll see what happens to the market cap immediately after the deal closes. So with that, I will play the fourth quarter earnings call, a little bit of a longer introduction period, trying to explain the overall deal and how we plan to try to present that in the numbers a bit. But like I said, I'll get into further parts of that after I finish up with the numbers.
Good morning and welcome to Discovery's Q4 earnings call. With me today is David Zaslav, our President and CEO, Gunnar Wiedenfels, our CFO, and JB Perrette, President and CEO of Discovery Streaming and International. Before we start, I'd like to remind you that today's conference call will include forward-looking statements that we make pursuant to the safe harbor provisions of the Private Securities Litigation Reform Act of 1995. The forward-looking statements include comments regarding the company's future business plans, prospects, and financial performance, as well as statements concerning the expected timing, completion, and effects of the previously announced transaction between the company and at&t relating to the Warner Media business. These statements are made based on management's current knowledge and assumptions about future events and involve risks and uncertainties that could cause actual results to differ materially from our expectations. In providing projections and other forward-looking statements, the company disclaims any intent or obligation to update them. For additional information on important factors that could affect these expectations, please see our Form 10-K for the year ended December 31st, 2021 that we expect to file post this call, and our subsequent filings made with the U.S. Securities and Exchange Commission. And with that, I'm pleased to turn the call over to David.
Good morning, everyone, and thank you all for joining us today during this incredibly exciting time for our company. Our fourth quarter capped off a strong 2021 as we near the finish line of our transaction with at&t to create the world's most dynamic media entertainment company, Warner Bros Discovery. Upon close, Warner Bros Discovery will stand on incredibly solid footing, creatively and financially. This is a real company, and we expect to deliver meaningful free cash flow over the near and long term. At Discovery standalone, we ended the year with $4 billion of cash and generated substantial free cash flow this year, over $2.4 billion, even after absorbing over $1 billion of losses from our next generation investments. And our free cash flow will grow meaningfully from here. As a company, when we come together, we will stand on firm footing, look to benefit from both a very balanced business model and from the cost synergy tailwinds we expect to result from our merger, supporting our expected reduction in gross leverage to 3 times or below.
I know a lot of people were pretty excited with those 2 green days on Thursday and Friday, but I honestly wasn't that excited.
The new company. Our vision for Warner Bros. Discovery is simple.
Yeah, it's always good to be one of the people that's actually excited when things go down.
Complete menu of IP and content stand to achieve success. And I believe Warner Bros. Discovery has the most attractive content in the business. From Batman, Superman, Wonder Woman, Harry Potter, Game of Thrones, Euphoria, 90 Day Fiancé, Hanna-Barbera, Looney Tunes, to the Food Network, HGTV, Discovery, HBO, And great personalities like Martha, Chip and Joanna Gaines, Guy Fieri, the Property Brothers, and Oprah, plus CNN, the premier global news network with real resources and news gathering services all over the world. Sports with Eurosport, the Olympics, NBA, NCAA March Madness, Major League Baseball, and the National Hockey League, making us a global leader in sports alongside a wealth
I'm prepared to profit either way.
Content all over the world, content that we've produced and garnered for the last 20 plus years. Taken together, we will have a broad menu of content.
I try to hold positions that can do really well in really up markets, and also some hedge positions that do well in down markets, so that there's stuff to buy and sell on both ends.
Content together, we will have one of the most compelling offerings in the marketplace, and at a great value to customers. This was the premise and the vision that John and I shared when we put this deal together nearly a year ago. Initially, we planned to see how all these existing and complementary content pieces fit together, how well our package of content nourishes and enriches consumers, and what it does to churn and growth. From there, we can evaluate areas where we'll need to spend to fill in for our offering. Together, we already spend aggressively across all demos and genres, and we'll have an even greater ability to do so as a merged company. And know we have the resources, we plan on being careful and judicious. Our goal is to compete with the leading streaming services, not to win the spending war.
Smart.
Whether breaking new franchises or reimagining and refreshing existing ones, we will have a truly scaled and diverse content engine with IP ownership across a highly monetizable collection of IP. Perhaps most importantly, we are not solely dependent on one business model as we reach across multiple platforms and touch points. Every leg of the stool.
That part I don't think is smart.
To direct to consumer.
I think they should just roll it all together.
And monetization. As one of the leading content arms dealers in the industry, Warner Bros Television is formidable. And as a company, we will also be uniquely positioned to better serve advertisers and distributors globally. Said another way, we can monetize across any number of different cash registers. Consider that Warner Bros Television has over 100 active series being sold to over 20 platforms and outlets. It's a content maker and content owner, generating significant revenue, free cash flow, and most importantly, optionality. There's not a lot of content makers out there, certainly not of the scale and of quality that Warner Bros. Television is in the marketplace today. And particularly at a time when the demand for quality television production has never been stronger. An important distinction when considering the asset mix of this company. A very real, very balanced, and very complete company. We have a lot of muscle memory from the Scripps merger, which enabled us to thoroughly re-examine how we conduct our business. And we took that opportunity to better align our management, operations, and processes during a time of pronounced industry disruption and change. I believe that this same dynamic exists with the opportunity ahead for Warner Bros. Discovery. Turning briefly to the quarter, I'd like to call out a few highlights while Gunnar will take you through in more detail the puts and the takes. First, on the advertising side, underlying demand across our networks and channels has been resilient. Overall 2021 global advertising revenue increased 10% over 2020, with growth from both domestic and the international segments. In fact, international segment advertising revenue increased 23% in 2021, excluding the Summer Olympic Games, finishing the year on a strong note with growth across all regions. Here in the U.S., I'm pleased with our solid end to the year. Despite a marketplace that has endured some headwinds across COVID and supply chain issues, helped in part by our outperformance against an industry-wide strong 2021-2022 upfront. At the same time, we've been very pleased with the results of our recently renegotiating distribution deals in the U.S. The team has done an excellent job continuing to demonstrate to affiliates that our portfolio is a great value, and they've clearly seen that reflected in our numbers this year. Within direct-to-consumer, Discovery Plus continues to perform very well. We end the year with 22 million total subscribers, passing peak investment loss levels, supported by consistent and continued strong KPIs, advertiser interest, and overall monetization efforts. As previously discussed, we've thoughtfully and tactically managed our rollout and will continue to do so while sharpening our focus and gaining perspective for the next leg of our direct-to-consumer journey with Warner Media and HBO. Worth noting, we achieved a significant milestone this past quarter.
Yeah, I'm mostly thinking about this valuation just from the Warner Media perspective, and I'm honestly not thinking about Discovery Plus that much, but
consistent with the US.
They have done better in the last few years than I would have expected.
Quite seamlessly, enabling a more feature-rich and personalized consumer experience. These efforts should ultimately drive better consumer engagement, higher retention, and ultimately lower churn, further supporting the trend we've enjoyed over the last few quarters. This replatforming also enables the rolling out of an ad-light tier to Discovery Plus in select international regions, something, as you know, that was not contemplated when we launched at the end of 2020, and which we expect will figure meaningfully in our eventual merged offering. The opportunity here is large, and we look to best practices from the U.S. We expect to launch the UK in March, with additional countries in Europe having been identified.
I've been adding to Facebook.
As part of our global content strategy,
if you told me a year ago that I was going to have a Facebook position averaged under 200 per share, I would have been like, no way.
In many markets, and we are excited about the innovative deal with BT in the UK, where, as we announced a few weeks ago, we are in final exclusive negotiations to create a rich, extensive portfolio of sports content in that very important UK market. We will combine our Eurosport UK portfolio with BT Sport, bringing together key matches from the Premier League and all of the UEFA Champions League, Premiership Rugby, Olympic Games, Cycling Grand Tours, and Grand Slam tennis. This will create a more compelling and simplified sport offering in the UK and Ireland, while also advancing our broader strategy of bringing sport and entertainment to more consumers with Discovery Plus. Staying with sports for a moment, and fresh off the Winter Games from Beijing, despite the many challenges and obstacles, we were very pleased with the event, marked by healthy growth in subscriber additions, streaming minutes, and total viewers across our combined portfolio. Though perhaps most importantly, and building upon the
sentiment's really bad,
bad,
but that's how you know it's a good time to buy.
Reinforce the value of delivering a much richer product experience.
Before I started streaming, I actually was listening to the Lex Friedman podcast. Mark Zuckerberg just did an interview with him. I only got about halfway through it, but
as well as to introduce more.
It's good because you don't really usually get to hear him speak in a long-form interview outside of a business context. So.
And lastly, one closing thought before I turn it over to Gunnar.
I recommend it.
Depending on how soon we can complete the closing of our merger, this earnings could be our last as a standalone Discovery. For me personally, it has been the honor of a lifetime to run this very special company over the last 15 years.
I hope it's the last.
Alongside such an extraordinary group of leaders, employees, and board members. Folks that I've gotten to work with and learn from, like John Malone, the Newhouse and Myron family, and the guy that started this all out of a garage with a crazy idea that Discovery could change the world, my great friend, John Hendricks. Having accomplished so much and to have had such a blast along the way, I often remark, this job is such a blessing of a lifetime. And we're all so lucky to be in this business and to get to do what we do. and I could not be prouder of what we've achieved together, but recognize that our most exciting days and biggest tests are ahead of us.
It's a really good podcast in general.
We absolutely can't wait to share the next leg of this journey with all of you. To close, I truly want to thank those of you that have joined us quarter in and quarter out during this first very formative chapter of Discovery's corporate journey. We believe the next chapter will be even more rewarding and fulfilling. With that, I'd like to turn it over to Gunnar.
Thank you, David. I'd like to start by echoing David's comments. This was indeed an exceptional year for Discovery, and one in which I believe we made significant strides across our financial, operational, and strategic priorities. Speaking to our financial accomplishments, I am proud of our continued focus on transformation and efficiency during continued disruption in our industry. Notwithstanding over $1 billion of losses from our investment initiatives in 2021, we finished the year with over $2.4 billion of free cash flow, a 64% conversion of AOIBDA. A true testament to both the resiliency of our core networks as well as overall balance of our global portfolio of assets. Moreover, we ended the year with $4 billion of cash on our balance sheet and net leverage of 3.0 times, both of which have continued to improve thus far in 2022.
Yeah, I do like how they've improved their leverage over the course of the year.
Current momentum, I remain very
rather than just relying on the
projected
market cap
net leverage
adjustment.
at closing of 4.5 times or better, and reiterate that our long-term target leverage range for Warner Bros Discovery remains 2.5 to 3 times, which we intend to achieve within 24 months from close and possibly sooner.
Yeah, so that gives me confidence.
Now turning to the quarter, let me briefly provide some color on Q4 results, for which, from a high level, underlying trends are more or less consistent with those of the last few quarters. In the U.S., Q4 advertising was up 5% year over year, largely driven by strong pricing in linear and further supported by continued traction in the ad-light tier of Discovery+. As I mentioned on our last call, and not surprisingly, we have seen hints of softness in the scatter market due to supply chain disruptions and some category softness around COVID. Visibility remains limited as supply chain issues persist, and we currently see low to mid-single-digit growth in Q1. U.S. distribution revenues increased 17%, helped by Discovery+ and higher linear affiliate rates, more than offsetting declines in linear pay TV subscriber numbers of around 4% for our fully distributed portfolio. Turning to international, which I will discuss on a constant currency basis. Starting with advertising, momentum is quite a bit stronger than here in the U.S., increasing a healthy 12% in the fourth quarter, benefiting from robust performance in all regions. We continue to enjoy pricing upside resulting from healthy demand across EMEA, particularly in the UK, Poland, and the Netherlands, while Latin America continues to recover nicely, also helped by share gains in key markets like Mexico and overall healthy demand. We are at the very early stages of rolling out an international ad-light tier for Discovery+, first in the UK and Ireland in March, with additional markets in EMEA to follow, enabled by the international replatforming, which David previously alluded to. We are enthusiastic about the incremental consumer-focused feature enhancements, which we expect will drive better engagement, resulting in continued churn reduction and monetization upside. Distribution revenue increased 5% during Q4, as ongoing affiliate fee pressures in certain EMEA markets have been more than offset by the growth in Discovery+ subscribers, with strength in key markets like the UK, the Nordics, Poland, and Brazil. On the expense side, total Q4 operating expenses increased 9%. Cost of revenues decreased 4%, helped in part by a more normalized sports schedule in Europe, partially offset by continued
one more
investment
year
in
and we can
content
do
for
the
Discovery+.
5-year average.
SG&A increased 29% due to overall marketing spend to support Discovery+ subscriber growth and new market launches. Lastly, operating expenses in our core linear business decreased in the low single-digit range for the year, in line with our guidance. To that end, I'm very proud of the efforts across the company to support continued efficiency and overall cost management. AOIBDA for the quarter was up 15% to over $1.1 billion and was down only 8% for the year to $3.8 billion, which, taken in the context of an incremental $600 million investment in next-gen initiatives and a roughly $200 million loss for the Olympics, I am extremely proud of our result. I do want to take a minute to call out both the criticality and the resiliency of our core linear networks business. We continue to invest and support these important brands and franchises, while at the same time look to drive operational efficiency across the globe as we maximize their contribution to free cash flow and to fund our continued investments in direct-to-consumer. Now turning to some housekeeping items and a couple of items to consider for the quarter as you update your models. First, U.S. other revenue was up $74 million during the quarter due to a non-recurring non-cash item which flowed 100% to AOIBDA and which was a positive 8 cents per share impact. Second, we recognized a 13-cent per share non-cash loss from the $15 billion of notional interest rate hedges that we implemented in the third quarter to mitigate interest rate risk for future debt issuances to finance the cash portion of the Warner Media transaction.
Yeah, he's a very popular.
Call, we are required to report the changes in fair
part of the reason I
value
feel
on our
comfortable
income
recommending
statement,
him.
as the derivatives do not qualify as hedges for accounting purposes, which could result in some additional variability to our net income until the Warner Media transaction closes. Third, Group 9 signed an agreement to merge with Vox in December 2021. As a result of the transaction, which closed earlier this week, and the estimated value of our ownership in the new company, we recognized a 10-cent per share non-cash impairment charge. Finally, the impact of PPA amortization during the fourth quarter was 51 cents per share. This is higher than in prior quarters as we reassess the useful lives and amortization method for all the purchased customer relationship intangibles. While the useful lives of these intangible assets did not change, we decided to take a more conservative position and accelerate amortization to better align with expected cash flows. As a result of this, our Q4 D&A expense increased by nearly $200 million. Adjusted for all of the above, EPS would have been 73 cents per diluted share. Our full-year effective book tax rate was 16%. Our cash tax rate was 25% for the year, excluding PPA amortization. For 2022, we expect our tax rate to be in the mid-20% range, while our cash tax rate is expected to be in the low to mid-20% range, excluding PPA for Discovery standalone. And based on our planned rates, we expect FX to have a roughly $90 to $100 million negative year-over-year impact on revenues and a negative $5 to $10 million impact on AOIBDA in 2022, inclusive of the existing hedges. A quick update on where we currently stand in the transaction process. We have already satisfied most of the conditions to close. Unconditional clearance from the European Commission, the expiration of the HSR waiting period, clearance from all other
the European Commission is often the hard part.
Private letter ruling from the IRS for at&t. We also filed our final merger proxy earlier this month and have scheduled our stockholder meeting for March 11th. Following the vote, and assuming the deal is approved by our shareholders, this puts us on a clear track to close in early Q2. That will be a wonderful achievement that reflects our best case estimates from a year ago. I am encouraged by the continuing operating and financial momentum at Discovery during what has undoubtedly been a hectic year. And we could not be more excited to get going on integrating the two companies as well as delivering the promises we have made to you, including $3 billion plus of cost synergies and driving significant free cash flow to deleverage the company down to our target leverage range within 24 months.
There we go. I think that's correct now.
Having recently conducted some high-level meetings across our respective companies, I think it's fair to say that both the Discovery and Warner teams are eager to begin collaborating in earnest to build one of the most dynamic media entertainment companies in the world. Now with that, I'd like to turn the call over to the operator, and David, JB, and I will be happy to take your questions.
Ladies and gentlemen, as a reminder, to ask a question, you will need to press *1 on your telephone. To withdraw your question, press the # key. Please limit yourself to one question and one follow-up.
Have I heard on the closing Swift?
1 moment for your first question. Your first question comes from the line of Robert Fishman with MoffettNathanson. Your line's open. You may now ask your question.
Hi, good morning. Given the new geopolitical risks from Russia, can you just remind us what % of Discovery's revenue come from Europe and Asia, or what it would be on a pro forma basis for Warner Bros. Discovery, and whether you've seen any early pullback on advertising in the region, obviously understanding that the Olympics just wrapped up there? Then I have a separate one for Gunnar on the amort policy.
Okay, go ahead, Gunnar.
Oh, you mean
David.
the Swift system? Yeah. Okay.
Yeah, look, I could take it.
Yeah. Hold on.
Michael, it's an immaterial proportion of our financials. It's about 1% of profits that we're.
All right, done with the 5 years. Yeah, no, I'm paying attention to all that pretty closely. I'm not super concerned about it. For me personally, I guess. I'm sure it's gonna be pretty devastating for the economics of people who live in the region. But you know, I'm not sure what they'll do, and we'll see whether or not they actually do it. From my understanding, there's a decent amount of hesitation from some of the European allies and stuff. So I don't know. We'll see what happens with all of that. But yeah, I'm kind of paying attention to all of it. I'm much more concerned, honestly, with the disruption to a lot of the trade goods that comes out of the Ukraine, and to some extent Russia as well, especially agricultural goods and fertilizers. There's a lot of concerns about that. And another video I would highly recommend is Peter Zihan, who does geopolitical discussions every year around a book that he titled The Disunited Nations. He did a lecture recently talking about the Ukrainian conflict and his expectations of how that'll affect a lot of the trade disruptions that we're already going through. And yeah, that's the stuff I'm honestly much more concerned about. Like, we were already set up for a lot of parts of the globe to possibly be dealing with famines in the next 5 to 10 years, and the Ukrainian conflict is only going to make that worse. So we'll have, anyway, getting back to Warner Bros Discovery. We'll start here at the bottom with the sales to capital ratio as per normal. As you can see, they pretty much have a pretty consistent in this kind of like 40s to 50s range sales to capital ratio, which, like I said, is a lot lower than we would have expected based off the industrial expectations, because they have the sales to capital ratio is a little bit closer to the broadcasting levels of what you would expect for the amount of revenues you get for the amount of content production you have to do, compared to an actual pure play advertising based form of business. So it is a pretty terrible sales capital ratio, though their margins were a little bit better than I was expecting. It actually does seem to come in line with the industrial expectations overall, which either way, it still makes it a very expensive part of the business, which is one of the reasons that that they finance everything through debt, because frankly that's just the better way to do it. It's honestly too expensive for equity shareholders to operate in this type of business without leverage. But getting into the overall situation, you can see that they actually do at least have a solid shareholders equity, though obviously it isn't very strong relative to the total liabilities and total size. It is at least proper and positive, and the retained earnings are positive and all that. As we said, we have about $14.4 billion in long-term debt, not counting the current debt that's going to expire in this particular year. So you can add that onto the $43 billion they're going to expect to get there, but there is at least $4 billion in cash. So it's like, yeah, there's gonna be a lot of debt, but they do have a decent amount of cash on hand, and that's assuming that there's not a trade-off between the debt and the cash over the course of the year, of course. Returns on invested capital, single digits, not very impressive. Like I said, it's pretty rough on its own, which is why you kind of need some leverage at least to get the return on equity up to at least into the teens, which is still not very impressive, but at least it's in a range that's respectable at this point. Though it would be better if they could get it into the 20s at least. Looking at the overall free cash flow to equity, you can see over the entire period they've had about $5 billion in cash flow that they could have paid out to their shareholders. Though over the entire period they've only paid out about $2.1 billion, so they're definitely not overpaying their shareholders. But that's partially because of well, I mean, they've never been a dividend payer in the first place, so they wouldn't have that kind of pressure on them. But they don't have a huge amount of share buybacks going on, obviously, because they have this kind of cash flow issue, and a lot of people are more concerned about that, and that was more about managing the expansion of their content. And getting to the correct income margin, like I said, you can see over a 3-year period it's about 12-13%, which is, again, it's not super strong, but it's better than like AT&T's while they have Warner Media, for example. So that, that's at least pretty decent to have at least this kind of solid upper into double digits, at least for some years. You can look over a 5-year average, it comes in closer to 7 or 8%, but still. So we'll get into the numbers a little bit further. There's not honestly that much to be learned from these numbers looking into the future, considering we're going to be basically creating a new company. So it's like, it's not like we're gonna do a lot of like, oh well, look at the trajectory and let's project it this way. The only thing that's really we're gonna think about in terms of that is like, we're gonna think about their historical sales to capital ratio, because we're gonna think about that as like the actual capital efficiency capabilities of the management, and the margin. We're also gonna assume they kind of keep in similar margin ranges. So obviously, like I said, what we're doing for the revenues is going to be based off of the projections of what Warner Media Discovery has, though we are going to give them their typical kind of low single digit on average growth moving forward after the deal. That's kind of, we're just going to be just a low single digit, 2-3% kind of expectations. Anyway, I'll continue the call while I work.
Generating in the affected region here.
But JB, if you could just comment more broadly.
I would say in the Ukrainian market itself, obviously, it's absolutely de minimis is the short answer. In Russia specifically, as you may have remembered a couple years ago, when the regulatory regime changed in the country, we were obligated to restructure our agreements to actually be represented by a local player. We did that, and to become in compliance with the local regulations. So we already have a deal structure in place that is partnered with a local Russian entity. And so for the time being, based on, obviously this is a very dynamic situation, based on everything that we've been able to study up until literally real time this morning, we don't see any impact, but we're going to continue to track it and see. And as Gunnar said, even if you include the Russian market, it's still a very immaterial in respect to the total Discovery company. As it relates to the larger European footprint, obviously for markets that are important to us, like Poland, like some of the Eastern European markets, which are the most likely to be affected, again, for the time being, we haven't seen any impact. We're pacing very nicely for the first quarter. But that is a situation that is going to continue to evolve, and we'll continue to track it.
Yeah, I'm not really worried
and
about
then for
too much
Gunnar,
disruption for them.
On the change in amortization policy, can you discuss if you're also re-examining the changing viewing behavior habits and how that might impact any of your content amortization included in EBITDA?
No, Michael, this is really, I mean, this is, it was a review of our accounting methodology here. Remember, this is purchase price allocation that we took on with the acquisition of Scripps. And, you know, obviously we review these on a regular basis. We've obviously also spent a lot of time thinking about purchase price allocation for, you know, the upcoming Warner Media deal. And, you know, as such, this is non-cash. It's what we paid for Scripps. And I just generally like to take as conservative as possible a position here. You know, there's no benefit from having these intangibles.
I don't know why I skipped all the way down.
So what's going to happen is you saw a $200 million impact in the fourth quarter. But again, we're not changing the amortization period. We're just front loading the rate of amortization. So this is going to just increase the amortization of these positions for the next 2-3 years, and then decrease the amortization in the outer years.
There's some big stock buybacks.
Coming off of Gunnar's point about
13% common yield that year. Wow.
That if you look at our company today and how we came together with Warner, none of that would have been possible, in my view, without the business that Ken Lowe built. And when I say Ken Lowe built, I mean, as a real entrepreneur, came up with the idea for those channels at a time when broadcasters were dominant and everyone thought a home channel didn't make a lot of sense, but home and food and the personalities and understanding brand and building a great culture and a fantastic business. And when we came together, that really gave us tremendous strength and diversity in nonfiction. It also gave us more confidence to go to the market with D+, and a much broader menu and bouquet. That transaction and the opportunity to work with Ken over these many years for all of us has just enriched the company and positioned us to be able to do the Warner deal, and positions us, I think, to be more successful because that content has worked really well around the world. So
Thanks, Robert. Next question.
Great. Thank you.
Actually, hold on, Michael. I should have. I didn't properly answer your Robert. I didn't properly answer your question because you were also focused on content amortization. That's something we also obviously confirm on a quarterly basis, and there was no changes to these policies, last year. So again, you've got the linear world, the potential of further exploitation of content in the digital world. Those are sort of balancing each other out right now. So we haven't made any changes there and didn't see any need for that.
Got it. Thank you.
And your next question comes from the line of Doug Mitchelson with Credit Suisse. Your line's open.
Oh, thanks so much. David and Gunnar, would you just talk about your confidence level in the $14 billion EBITDA and $8 billion free cash flow guidance for 2023, and if that confidence has evolved at all, and why? And then I guess the follow-up to that is
necessary.
Should we look at that level of guidance, $14 billion and $8 billion, as suggesting you don't see a need to ramp content spending rapidly, which a lot of folks are worried about? That looks like a guidance that would suggest you're just going to continue along the path that HBO already had planned for their content spending ramp. So any correlation between that guidance and your intentions regarding content spending would be helpful. Thank you.
Sure. Let me start here. Number one, yes, full confidence in the guidance that we gave. When we announced this deal, again, as you know, we're in an approval process here. So we have done some more work, but are eager to get into the detailed planning of these synergies after closing. But again, everything we've learned so far has, if anything, given me more confidence in our ability to generate these numbers. When it comes to content investments, we've received that question a lot over the past couple of weeks, understandably, given what's been going on in the ecosystem. A couple of things here. Number one, we have in our numbers baked in a very significant increase in content spending, and we have put zero synergy against that. Number two is we are currently spending at a peak level, or at least the highest level that we have seen in the history of this company. We spent more than $4 billion for content in 2021 at Discovery alone. And obviously, also on the Warner Media side, they've seen increases in spend. So we are definitely spending enough from my perspective. The key question is going to be, how much is going to be enough going forward? We have plenty of room in our business case. And I will also say, as David said in his opening remarks here, this is, for us, it's not about winning the spending war. Money doesn't score goals, as the European soccer analogy would be. We will have a greatly complementary portfolio of content focus areas between Discovery Plus and HBO Max. As a matter of fact, we're going to be covering all four quadrants like no one else. And that could actually drive to content efficiency that we haven't been able to get as two standalone companies. At Discovery Plus, we have invested in content in areas that's slightly outside of our lane in order to broaden the appeal. And certainly everybody has noticed the efforts on the HBO Max side to get more female, et cetera, with investments that might not be sort of perfectly in the wheelhouse. So I actually have hope that we might be getting away with a little less content spend, but we certainly have taken a conservative approach and put in a very significant room for increases. I don't know, David or JB?
Yeah. So, look, I think we start with the premise that the idea for this transaction was we have a library as big as Netflix with content that people love in the U.S., local content around the world, in the entertainment and nonfiction space and in sport, and that when we bring that together with HBO and the best TV library in the world, in my view, and motion picture library, that the first question is, how well does that do? We have a very low churn product in the U.S. Our churn is getting better in Europe as we've made it broader. And when we put these two together, I think it's the broadest, most compelling offering of content available. And it appeals to from the kids that are very young to with Looney Tunes and Hanna-Barbera and Harry Potter, to the DC content, to the content that 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 older people and every generation loves. And we see that there's also a different viewing pattern between what's going on at HBO Max and with Discovery Plus. A lot of our content is viewed throughout the day. So the first question is, how do we do when we come together? What happens to churn? What happens to growth? As I said, we are a real company. What I mean by that is we're going to be generating $8 billion or more in free cash flow. So we have plenty of money to spend. That already assumes that we're going to spend more money on content. But we're not going to just spend just to have more content on the platform. The key to these platforms, which is true of free-to-air channels and cable channels, is you spend enough that you could nourish an audience, that they want to spend time with you, and that they feel that you're you're the place that they want to be and you're important. Low churn, high usage,
the Treasury. I'm like,
by
what's
many
going on
people
here?
in the family. And we're going to be very careful about looking at how
There
we
we
do.
go.
And we believe there's a chance that we're going to do quite well. And we also have very low-cost content, and that we're not going to have to increase investment significantly, that our bouquet will be differentiated and compelling. But we do have the resources if we see that spending more will get us more growth and lower churn and good economics on ARPU. But we'll be very careful because we have a real company that's generating real value.
Thank you.
Shots fired.
And your next question comes from the line
Real
of
value that
Philip
could be
Cusick
diminishing, though. That's the
with
problem.
JP Morgan. Your line's open.
Hi, guys. Thank you. I wonder if you can talk about, just remind us how you think these days, David, of cost savings and synergies in Warner. Compare the difficulty and size of the opportunity versus those to the Scripps deal. Anything changing there as you've gotten more into it? Thanks.
Why don't you? We've been side by side on this for the last several months, and the good news is that we've been digging in with Ann and with the team, and when we've been able to kind of confirm a lot of what we thought. But why don't you, as the general here, just take Philip through.
Philip, the short answer here is we're fully aware of the fact that this is much larger and it's going to be much more complicated and complex than what we dealt with when we brought Scripps and Discovery together. That said, all the work that we have done, again, as I said in my earlier response here, if anything, I've gotten more excited about the opportunity. We've had first very high-level meetings with the Warner Media side as well that are going very well. And remember, we have a couple of unique points here in the constellation. One is that a lot of the cost saving is actually going to come out of cost avoidance. Right now, we're running two completely separate direct-to-consumer technology stacks and marketing operations. And we're spending, roughly $6 billion for technology and marketing between HBO Max and Discovery Plus. Clearly, once we have successfully migrated those technology stacks into one, there is going to be tremendous opportunity to reduce costs. And the second point here is that for both plans, we had anticipated very significant investment increases, which one of those ramps is going to go away as well. That could easily make up for half of the total cost synergy potential here. And then we have the linear portfolios, with which I think we on both sides have a lot of experience, and I've been encouraging people to go back and look at how the efficiency change when we combine Scripps and Discovery. There's just a lot of very straightforward opportunity there. And then what I do want to point out as well is all the areas in which we have not assumed any cost synergies. Again, I've already mentioned content, but also the entire studio operation, CNN, et cetera, et cetera. So again, I think what we're going to see is that we're probably going to broaden the scope of potential initiatives once we close the deal. But I feel very good about our ability to get at these numbers.
The other point is that we haven't assumed any revenue synergy, and the ability to come to market with, in the U.S., the broad bouquet of content means that we can service advertisers and distributors much more effectively.
forgive me if I'm premature on this, but there's been a lot of headlines about CNN Plus ramping up. Seems like there's a lot of business model overlap there with Discovery Plus. Anything you can add about that?
We will in the near term sit down and get have a real business plan discussion with the people at CNN and CNN Plus. We haven't had that yet. We haven't seen it. I've been watching a lot of CNN. This is where you see the difference between a news service that has meaningful resources globally, news gathering resources, the biggest and largest group of global journalists of any media company, maybe with the exception of the BBC.
Yes, it's one of the things that's interesting about this deal. It's taking a company that was decidedly
CNN is going to multiple
U.S. focus and turning it overnight into an international
in
company.
Ukraine, in Poland, in Russia, on the ground. And there's no organization.
Though it is installing a CEO with experience in that area, at least.
That can do what CNN
still,
does. And I think it becomes very clear as you go around the world and you look at other news channels where people are sitting behind desks and giving their opinion about what's going on. There's a news network that's on the ground with journalists in bulletproof vests and helmets that are doing what journalists do best, which is fight to tell the truth in dangerous places, so that we all can be safe and we can assess what's going on and what's dangerous in the world. So it's a proud moment for us to watch what's going on there. But because of this deal has not closed yet, it's that CNN is being run by at&t, and we're in the beginning process of getting the details on what they're doing.
And it's worth, Dave, I can just add one thing on the synergies, Philip. The other opportunity that is significant is that the Warner International basic channels business is about 10 times the size of revenue of what Scripps was. And so I think also the opportunity on the channels integration on international will be much more significant than it was in the Scripps business.
Thank you again.
And your next question comes from the line of Jessica Reeve-Ehrlich with Bank of America. Your line's open. You may now ask your question.
Thank you. Good morning, everyone. So we're on the cusp. You're on the cusp of closing the deal, and the hard part is obviously in front of you, given the changes you need to implement. Where should we expect to see early results in revenue and costs, and maybe specifically the upfronts in May, and it seems like you'll close before then. The old Time Warner or Warner Brothers traditionally had silos between entertainment, news, and sports. Do you expect to go to market with all segments under one sales force? If yes, what are the pros and cons of doing that? And my follow-up, I'll just ask now, you called out the Olympics performance, which is clearly very different than the U.S. experience. Can you talk a little bit about the lessons learned from the first two Olympics and expectations for Paris in 24?
Sure. Well, first, we've been focusing really on cost. And after we close and we get into the business, we'll have a chance to think about revenue opportunities. But our number one priority has been focusing on cost and analyzing opportunities in synergy that reflect the $3 billion. We can get more into the synergies, Gunnar, but I just wanted to speak to the Olympics and then pass it to JB. We have focused very hard throughout Europe with all sport in really driving local recognition of athletes. Who are the local athletes? What's at stake for them? Where did they come from? Why do you care? And what we've learned over the years with our 3 sports channels and with our direct-to-consumer business is it's not just the love of the sport. It's the love of the athletes. And that when you see 8 skiers lined up, you want to know the backstory. And that has really worked for us across sport. And JB and Andrew and the team spent months promoting local athletes with the objective that if you went down a main street in any country and you said who you're looking forward to seeing in the Olympics, that the objective was that you'd be able to name between 5 and 10 people. And I think that had a lot to do in terms of execution with what we saw with viewership across Europe. JB?
Yeah, look, I think, Jessica, we've learned a couple things. The focus, as David said, I'd say on the production side has been very much focused on content and storytelling, on local heroes and athletes. I think also we've understood in this digital and social age that people want to see more authentic representations of the athletes' lives, and so we've also introduced things like family cams and showing, particularly in this virtual world of the last 2 games where a lot of the families have not been able to be on site, showing how their families and friends are rooting for them back home and bringing that and making it a more intimate, authentic experience of the full representation of the support crew that supports these athletes. And then lastly, or the last 2 things I'd say, we've also continued to build out the best set of experts in terms of on-air talent in the business by far. So people know to come to us because we have the best set of on-air talent that oftentimes are medalists themselves, Olympians themselves. And then lastly, we've really continued to invest in innovative technology to bring the games and the stories to life in different and innovative ways that are not gimmicky, but ultimately really bringing the storytelling to life. Augmented reality being one. We've done little simple things like our announcers being on camera and having feeds from our announcers who have obviously a lot of passion as they're watching their national games. So we've continued to innovate on technology, which has helped bring the games to life in a different way. And so we're incredibly proud of what our team has done, as David said, in a very difficult situation, and we're very pleased that both in terms of our linear ratings being comparable to what we saw 4 years ago in Pyeongchang, despite the put levels in that period being down double-digit, that our experience was very different than others, obviously, in the last, both this games and the Tokyo games, for that matter.
Gunnar, Jessica was asking about a little more on cost synergy. I think you covered a lot of it, but any other thoughts?
No, I mean, I think the one thing I would add, Jessica, to your point about the timing. Look, we want to hit the ground running. We have stood up integration management offices, both on the Warner Media side and on the Discovery side. You know, we've got full teams in flight working on setting up these work streams, et cetera. But that said, we're still operating as 2 independent companies right now. There's very limited interaction regarding actual savings measures. So with that said, what I would want you to expect is sort of an initial wave of savings after closing, which a lot of it is going to be straightforward, early quick wins. And then, we'll get to work on detailing out the longer term structure and setup. And that's the reason why we had focused our communication on 2023, because 2022 was always going to be a little noisy. We're coming together, a third into the year, et cetera. So 2023 is for me sort of the year sort of for the full on synergy capture here.
Our objective is get the deal closed and implement these work streams on cost, and then sit down and look at the opportunity to serve advertisers more effectively and efficiently. And we'll have the upfront. Hopefully, we'll be closed before the upfront. It looks like that'll probably be the case, and then we'll be able to.
I've seen some stuff about it.
Upfront strategy.
I did do a valuation of Foot Locker sometime last year, so it is on the watch list. And I had seen that its score had shot it basically to the top of the list. And then I saw
great. Thank you. Good morning, guys.
I saw a Jeremy Lefebvre video about it for financial education. Because I know he's a shareholder of it.
Unique business in its size, but also
I was definitely considering taking a look at it
outside of the company. You referenced that being something you sort of expect going forward.
I assume it's new 10Ks out. If not, I'll probably wait for that.
Feels like companies are trying to pull more content back in.
Oh shit!
And
what am I doing?
Perhaps in situations where they've sold externally, they've been disappointed with that decision. So maybe you could just talk about the balance there, given the size of the business, but also the interest in fueling your own platform. And my second question
maybe for Gunnar, is really on the long-term margin structure for the business, and thinking about the streaming industry more broadly. The guidance that you guys have given sort of implies a high 20% EBITDA margin, which is below the historical cable business, but definitely at the high end of the streaming business. So I guess the question is really, how do you see that converging over time? But also, when you think of a sort of scaled streaming business globally, what does its margin structure look like over the long term? Thanks, guys.
Thanks, Michael. I've been for many, many years in deep envy of Warner Brothers TV, having spent 18 years at NBC, must-see TV, and Jack Welch would often remind the heads of entertainment of this, that it was really Warner Brothers TV, that all those shows were produced by Warner Brothers. And the business that Channing is running right now is generating significant revenue, and in some ways it's doing two things. It's probably the best and largest producer of quality content, TV content in the world. We're in that business. We have a business called All3, as many of you know, where we're 50-50 with Liberty Global, with 35 production companies. That business has gotten, Jane Turton runs it, a lot better because there are multiple bidders for quality content. And when you look at Warner Brothers TV, it's
all right.
It's a very, very compelling business, and in a market where.
All right, so we'll go ahead and cut it there. Lots of interesting stuff that they talked about in the call. A lot of little interesting tidbits we kind of talked about here while it was working. So taking a look at the sales to capital ratio over the entire period, you can see it's remarkably stable. In fact, that's going to be something I'm going to say about a lot of their numbers in a few areas. The sales to capital ratio just between these 40s to kind of mid 50s kind of range is pretty typical. We can look at any of these average periods, and it's basically going to hardly shift its overall period. We'll go ahead and use their longest run average period. I'm probably going to use that for a decent amount of these base year numbers, just because it's kind of taking a look at like what has Discovery successfully been with over the long run, and then we'll think about the combination between them and Warner Media when we think about where they're going to move to, essentially. And now moving up the line to the balance sheet, there's not really too much more comments I was going to say about the balance sheet other than what we had basically already said. But in the cash flow statement, that's where things are a little bit more interesting. Again, the 3-year average for the return on invested capital, about 8%, which is nothing too amazing. Returns on invested capital, that comes to 14%. If we look at a 5-year period, that shifts it downward to 6%, but the return on equity comes to 12 to 13%. We shift it to a 9-year rolling period, it's back to 8 to 9%. Now the return on equity is up to 16%. So yeah, it doesn't really shift things around too much. You kind of just look at a longer, shorter period. They've kind of been a pretty consistent company. In some ways, that's been the problem, is because they've thrown a decent amount of good money after things and still managed to stay in exactly the same place. Here we are, the cash flow, another perfect example. I mean, look at how consistent this cash flow is, other than literally just a couple years. These 2 years right here, one super large, one super negative, that totally balances each other out. And then a decently low year back then. But so it's like over the entire time frame, we have a total of $11.3 or $11.4 billion in cash flow that could have been paid out to the shareholders. How much did they pay out? $8.3 billion, which is a pretty good range. It's about where you sort of want it to be. Want it to pay up as much as you can, but without really going over. It's almost like 21, without really being like 21. But either way, it definitely shows. The overall adjusted net CapEx, which is a total idea of what kind of reinvestment they've done over the entire period. You can look at a rolling 3-year average. You can see that part has actually been very chaotic. It's been up and down with how much reinvestment they've moved over things. So in the most recent few years, there was pretty strong reinvestment, other than 2021 when it's a little bit of a rollover. Which we'll see how that turns. They're talking about massive reinvestments, though there's also going to be amortizations. So on the net of it for the next 5 years, it's hard to say exactly which direction it moves. Getting into the adjusted net margin, this is definitely a little bit more of a chaotic number, but if we look at it over the 3-year period, 12 to 13%. 5-year period, it goes to 7 to 8%. 9-year period, it comes back up to around 13%. So you can see there's a little bit of some chaos here in the middle period, partially with the tax readjustment laws, as well as the some costs from the previous large acquisition that they did. So you can kind of expect some costs to work and play in the near term period, which means maybe it's actually reasonable to sort of assume the 5-year period for the base year, since we are going into another acquisition. So maybe that's a decent way to kind of look at this. This is a base year, but moving towards the 9-year average as the end point. In fact, I think I will go ahead and do that. Looking at their rolling adjusted cost of capital, 4.4%. We'll take a look at what it is on the book level, but that seems to be pretty consistent. Same thing with the tax rate. That's another thing that's been relatively consistent. They did have higher tax rates in the past, but then they also had some GAAP losses, so they've been able to lower their tax rate based off of the way they've operated. Not to mention they're about to go into more international focused parts of the business, so that's going to shake up their tax rate availabilities as well. So I'm willing to leave the 15 to 16% essentially in place. So we'll start to work on our future projections. Don't get hung up on this number. It has a lot of things in place that we're going to have to adjust, so let's definitely not focus on that. It already has some things in place because, like I said, I already put a decent amount of assumptions in. For example, we have the revenues right here. I already have it set to 20% as the lowercase scenario, with 45% as the higher case scenario and 35% as the mid case. Basically what this does is I'm assuming that we get to 2021 revenues being the combination of Warner Media's revenues from 2021 plus their revenues getting into 47.823, and so basically from that point forward, getting to the expected range of 51.4 billion in the 5-year forward period, and calculating back from this number, that actually gets an implied revenue CAGR for the next 4 years after this particular year of 1.46%. Which actually, hold on, 5 years, 5 years, because we're rolling from that number forward. So either way, basically outside of the acquisition, we're essentially assuming organic growth moving forward of 1 to 2% on expected value, which means with these revenue numbers, they look like really large jumps in revenue, but that's part of where that's coming from. Though we do have a bunch of complicated other things we have to adjust for to make sure that this is going to work out for other reasons, which we'll get into. Basically, now with this in mind, this is moving over a consistent CAGR period, so it's going to get to these revenues by the end period, but you'll notice that these revenues in the next few years are actually not anywhere near the amount of revenues that need to be. And so what I did here is I did calculate essentially the amount of revenues that I say are missing post the acquisition by these lowered numbers, and that comes out to be approximately $324 billion worth of missing revenues that needs to be accounted for in the capex expectations. Now I've already adjusted for this and created another number here that subtracts out all the missing numbers and then finds out how much extra revenues we've gifted them on top of the missing numbers, because we do want to give them a certain amount of excess revenues on top of this based off the fact that they've already done this acquisition, so it's not like they actually need to pay for it with their current sales capital ratio. So we're giving them a boost to their sales to capital ratio in excess of what we actually expect them to do in the long run. And that's how I get to this $2.3 billion number, which it should be understood it's a $2.3 billion per year number, which I personally think this is probably a little too high, especially since they were expecting to get $3 billion in cost synergies, and I'm willing to accept, and that's $3 billion over the next few years, so I'm willing to accept maybe up to $4 billion over the entire period, but then again, that's over a 5-year period, so $4 billion divided by 5 would get you like maybe 400 million, so this is way too large of a number. We'll get into some other aspects about that. Now, the net margin I chose to go with, I kind of just put a number in here, and I was willing to kind of readjust these things as I went, but we'll kind of look at that, I guess, right now. Like I said, I'm willing to think of the base year of 7 to 8%, where they're currently at as our base year number, and I'll use 50% of that as our worst case scenario. And then in our long range number, we were saying that we could expect them to possibly get up to about 13%, and I'm willing to use about 50% higher on top of that. I'll round up a little bit, and that brings it up to close to 18 or 19%. So, I mean, we can go ahead and just put it at 20%. That gets us a midpoint adjusted net margin of about 12%, which is lower than the 13% long range average, but it's still pretty good, I think, as far as that goes. As far as our expected value, I might be willing to just leave 10% in there, or maybe, yeah, we'll leave 10% in, because I want to assume sort of a worst case scenario on that. Make sure the worst case scenario still has an adjusted level of cap on here. Pay no attention to this. I know it's looking really, really good right now, but we still have other things we need to adjust for. So it's probably going to decrease the value once we do some other factors. We'll take a look at the sales and capital ratio. The debt to equity ratio, based off of the expected debt and the market cap expectations that we've kind of already got implied in, gets the current debt to equity ratio based off of the debt they currently have relative to the market cap we expect them to be at close of 24%, but that's absolutely not accurate. because of the fact that, like I said, we're expecting them to take on a huge amount of debt. So it does need to move up closer to 89%, which is why we have it moving to 160-40%. On a net, that gets us an expectation of 97. That's a little too high, so we do need to bring that down. Let's get this maybe to 120. And whoops, to do that. Bring this maybe down to 60, and we'll see what that brings it to 77. And we need to make a huge adjustment to the sales to capital ratio. That's making a huge factor on this. 68 versus the 90. So I do want it to be around sort of 70. Around 80. That brings it the expected to 71 before adjusting for probabilities. Now we go to the sales and capital ratio. Now this was the part that needs some serious adjustment. Like I said, we have an implied gifted revenue of $2.3 billion per year, which is way too much. We want to get it closer to like 400, which lowering the sales capital ratio should fix that because of the way that I've put this in, I think, hopefully. Okay, that did lower the number, but that didn't get it low enough. I might have to adjust the way I'm doing this as I work because there's a few kind of weird assumptions I'm trying to think out. On. Adjust the probabilities a little bit to get it kind of in line with what we expect. So that puts the post-deal COGR at about 1%, or COGR from 2021. I'm okay with that. I want to assume pretty low amount of growth because it's to an expected net margin of about 11%. That might be a little too high. I kind of prefer it around 10. It's a little bit better. I still need to do a pretty decent adjustment to the sales capital ratio, but I'm trying to get everything else a little bit more in line with where we want it to be. Wait a minute, that's right. We want to lower, increase it. Maybe 110. Bring it down to 170. It's 67. Oh, I do need to lower this. I think I may have screwed up something in the expected revenue. So, okay, they got it down to 492 per year. That's better, but like it made the value go up, and I'm a little baffled as to why that's happening. Maybe I shouldn't have included the no. I think that's part of the thing that's right. Let me think about the sales to capital ratio. A little It's like I expected the value to be pretty decent here, but this is shockingly good. I just I don't know, it's making me wonder what I've got wrong here. I do know I need to adjust for defaults, and that should trim a decent amount of it, but I'm not sure it's going to trim that much. So that's why it's like, I don't think this is lowering the sales to capital ratio for the worst case scenario. It keeps improving the value, and I'm not sure why it's doing that. That part doesn't make sense to me. Normally it doesn't move that direction unless there's some really interesting scenario going on, and that those typical scenarios don't appear to be the usual case, which is like a negative shareholders equity scenario or a negative return on invested capital scenario. Those scenarios aren't the case, so I'm a little confused as to how it's working out this way now. I'm trying to think about what I may have done wrong in my assumptions. $24. $72. $63. I guess I did have the highest end a little high, because it is going to bring the debt equity ratio post close roughly to around 70. So I guess the idea that it even moves down from there. Yeah, because this estimate I believe is a little off. I think that's part of the issue. I was running it off of this estimate. When really I should have maybe been just scaling up from this estimate. And that gets an implied lower number for the worst case scenario, which lowered the value. But still, 90% is still pretty high. Maybe I have to trim it back based off of the premise that I'm doing the excess revenues. So we'll cap it to 75, and we'll just leave the best case scenario as allowed to move upward. That brings us to 51. I'm probably gonna have to lean backward in the probabilities a bit. I mean, I already am, but we'll lean backward even more. I guess it's because I'm giving them the extra sales. That means by having the high debt to equity ratio for the huge increase in sales, that's actually making it so that it's not costing them a lot in order to have the sales. But that's part of the problem. It makes me feel like I should just reverse it. I don't like to do, and I've done it every once in a while, but that actually sort of improves the logic. It's a weird situation because of the way we're scaling the revenues up from this year. That's the part of the problem. So like if I had just put a pro forma year in for this one with 47 in right here, then I think we would be having a slightly different scenario. Although this is going to create a loop. I'm not sure I can actually do that. Yeah. Let's see. Oops. Accidentally created a loop. I was like, wait a minute, I can't actually do that. But all right, so yeah, okay. I didn't really want to do it that way, but I guess that's the only way that's gonna make it make sense. Anyway, we will scale back on this. That's gonna shift the probabilities 54%. That's a little have something like that. Six. Or no, maybe I guess I want to do it on the other end. Sales to capital ratio 0.57. Okay, where did that leave the excess? 557. We can bring the sales to capital ratio down a little bit. Increase the value, but that's okay in this case. That's no longer the problem. Okay. All right. There we go. All right, sorry, it took a little bit of a problem. I had to make sure that all of the acquisition logic checked out. There was a little bit of a backwards logic in a normal scenario because of the way that we had set the base here to their revenues without the Warner Media. It meant by having this large revenue growth in the worst case scenario year, while also giving them a low sales to capital ratio, but also giving them a high debt to equity ratio, meant that the high debt to equity ratio actually helped them because they were trying to take on the sales growth. So basically we were kind of screwing up the formula a little bit by having the debt to equity ratio scaled from high to low for worst to best. In this particular case, the inability to get access to capital is actually the worst case scenario for them, rather than the ability to take on more debt because of the high levels of the revenue expectations. So yeah, it just took them a little bit of a minute to figure out that problem. It's a little bit of a weird mix-up, and like I said, because of the fact that we don't have the proper numbers, there's a lot of uncertainty surrounding this investment just in general. So we'll do the default risks, and that should be it. I totally forgot to get that spreadsheet out. So the most recent year is about 1.71%. Definitely a pretty non-negligible amount of risk, which is per what I was saying, is I definitely expected there to be a decent trim as far as the risk expectations because of the amount of debt they have. But either way, there were still so many other factors involved that it just seemed weird with the way that the value was seemingly getting higher in the worst case scenario. It's like that's the opposite of what's supposed to happen. So that's why I knew there was a problem. Now, see just how much of the value gets trimmed off with this, unfortunately. Yeah, so decent amount of value trimmed off in the risks to default. So that should do it for us. Let's see, we got the correct number in there. All right, so this is ticker DISCA or WBD, depending on what time you watch this valuation or what month you watch this valuation. Discovery Communications or Warner Bros Discovery post merger, supposed to close here in the second quarter. U.S. Treasury was selling yesterday for 1.97%. We have a mature market equity risk premium of 5.16%, and I come up to a discount rate for the company of 8.56%, which all considered, I expected it to be decently worse than that. They do not have a dividend. 5 years ago, they had sales of $6.4 billion, and the most recent year is $12.1 billion, which came up to sales growth of 12.4 billion, or 12.4% per year, 13.4%. Apparently, I can't read numbers today. Per year for the last 5 years. They have sales to capital ratio for the last 9-year long range average of 0.47. Sales to capital ratio for their industrial expectations of 2.17, but we already went over the reasons why that's not really a very good measure for this particular type of company, unfortunately. Returns on invested capital over the 9-year period of 8.79%, and debt to equity ratio currently of around 24%, though that's scaled up to the expected market cap based off of full dilution into the Warner Bros Discovery company. So it could be a little bit of an understatement of the debt to equity ratio, but we're using that for, like I said, the reasons we have. It's just we don't have the proper numbers, and my model is built a certain way, so I have to operate it a certain way. Default risk in the most recent year of 1.71%, which is a pretty decent amount of default risk, all considered, because it's a per year number. Profit margins over the 5-year most recent year period average of 7.79% relative to industrial expectations of 12.45%, which again, we talked about, that's not really a great one for this company. Either way, they are currently selling for $28.24 per share. Probability distribution that we use is actually pretty tilted towards the less optimistic outcome for our model, which we typically don't do in most cases. This is a little bit of a special case where we're choosing to operate our distribution a different way, as well as we have the probabilities, I think, pretty heavily branched out relative to what we typically do. But either way, that gets us an expected revenue of, in the worst case scenario, of $30.3 billion in the 5-year forward period, or $78.1 billion in the best case scenario, getting an expected value of $50.3 billion, which comes to sales growth of about 32% per year for the next 5 years on average. Though again, that's basically all just this next year, and then after that, we're expecting them to grow basically about 1% per year. So just so that's understood, this number is obviously super misleading because they're in the middle of doing a huge acquisition. We're organically expecting them to grow on an expected basis of about 1% per year for the next 4 years after this next year, where they're expected to more than triple their revenues. Anyway, sales capital ratio we have projected for them of about 0.53 in the terminal year, so a little bit better than the more recent 9-year period, but not too much better on net. Returns on invested capital expectation, we have about 7.91%, so a little bit of a decline from they're currently at, and it does bring them below their discount rate, but not below their cost of capital, but it does bring them awfully close to it. So it's not a very great returns on capital overall, which we already talked about. This is not a super high quality business. It's mostly just the interesting deal operation we have going on right here that brings it of interest to us. Debt to equity expectations, we have about 56%. Again, that's making assumptions based off the fact that this debt to equity ratio is basically going to almost triple, and then they're probably going to bring down those costs over time. So we assume basically almost triple and then trim down from there decent bit, which gets us to the expectation of about 56%. Either way, that gets us to default risk over the 5-year period of on average of about 3.57% per year, which is a pretty significant amount of default risk. It is a huge amount of debt that they will have relative to the overall sales they have. So a huge amount of that is expected to be paid out in interest, which is where this default risk comes from. It's the risk that the capital markets will not stay functional enough for them to be able to roll over that debt, and therefore they run into the risk of having to default on it. So that's actually where a huge drain on the value comes from, is from the default risk associated with that debt. Either way, we have profit margin expectations of a range of anywhere from 4% in the worst case scenario to possibly 18% in the best case scenario, on an expected basis about 10.5%, which gets us profit expectations in the 5-year forward period of anywhere from $1.2 billion to possibly $14 billion in the best case scenario. On an expected basis, more like $5.6 billion. But yeah, it's a pretty wide range of potentialities based off of a pretty wide range of outcomes here. Though this is also a little bit warped because of the way that we had to apply our debt to equity ratio. That is worth understanding. That in most cases, I tell people to not think about the expected value and to instead think about more of like the range of outcomes. In this case, it's a rare scenario where actually the expected value is probably the better thing to think about for basically all of this valuation. The range are not actually a super individual great representation of specific potential outcomes. It's actually the expected value that makes more sense in this case relative to a lot of other valuations where I think it's actually this range of outcomes that's better to think about. So just interesting note about this valuation. Either way, that gets us a present value based off the discount rate we're currently using of about $32.91 per share, which is 16.5% higher than the current share price. And based off of the current price that they're selling at, we come up to 5-year forward value targets unadjusted for dividends that they can pay out during the period of anywhere from, in the worst case scenario, being completely worthless, basically being crushed by their debt is basically what happens in that scenario. Or in the best case scenario, possibly going up to a value of $119.05. On an expected basis, we see $49.62 as a pretty likely expected value, which comes up to an implied return for the next 5 years of 11.93%, which is not too shabby, especially compared to their discount rate. It does have a strong premium to the risk-adjusted returns for the shareholder. The value score we come up with for them is 0.87, which is pretty decent considering they have a pretty low quality business as far as sales capital ratio, profit margins, and returns on invested capital go. It is mostly these pretty decent ranges of outcomes that's getting this value score that even that high. Based off of current short-term multiples and regression output involving fundamental metrics, I get a suggested price of about $36, which is 27% higher than the current share price, but it does fall between our current present value and expected 5-year forward value target, which is always nice to see. Again, I don't like to make investment decisions based off this, but it is a nice kind of icing on the cake or timing based metric to think about, where if the value looks good here and it looks good here, then perhaps it's an opportune moment to jump at it. Which, I mean, on that front, it does make this look like a pretty decent opportunity, all considered. But like I said, I already am a shareholder of AT&T, so I already have my exposure to this company. I just need to wait for the deal to go through. The whole purpose of doing this valuation in large part is to figure out just how much value this adds to my AT&T valuation, which I will be probably doing on Monday, as well as it gives me an idea of what I may or may not choose to do with the shares once they're delivered to me after the deal closes. As I said, I do think it's a pretty decent chance that that 25 to 30% possibly of the market cap collapses on the day of the deal closes when AT&T shareholders receive their shares and immediately sell them, depending on how many people choose to do that. But it's also possible that those sales have already occurred for the most part, other than the few people who are going to wait for the potential return on that, and that therefore this valuation is already baked in, that fact that the market cap needed to collapse down is already baked in, and it's possible that that's the case. And if that's the case, then maybe there won't be a drop on that day. But either way, as of the close of this valuation, I do feel pretty confident leaving the shares in my portfolio after they come to me. This valuation makes me feel pretty satisfied with waiting on that, at least until they rise up to fair value. I think, though, I would also probably, unlike with a lot of my valuations, in this particular case, I would probably reevaluate as soon as a proper financial set of financial statements has been released for the company after close. So maybe in the second quarter results or in the third quarter results, I would do that, just as a slight addendum. So with that, that's going to do it for us today. As I was just saying, that this today's valuation is partially because I need it to determine the valuation of the company that we're doing on Monday, which is AT&T, a current holding of ours. And since this deal is related to them, I wanted to know what the valuation of Discovery is, so that I understand just how much the added shares from Discovery will add to the value of AT&T. So you can expect us to be covering that on Monday. As well as on Monday, there should be a couple economic reports in regards to international trade of goods and retail and inventory, retail and wholesale inventories, though we're not so interested in those second parts. But the international trade of goods will be an interesting thing to note on, as well as we discussed in the chat. I'm very curious to see where the market goes. Because there's all sorts of interesting buying opportunities out there, as well as hedging opportunities to take advantage of. So if you've watched this far and you've enjoyed content like this, it would be really, really, really appreciated if you could like the stream, subscribe to the channel, follow, share with anybody else that is interested in content like this. We would very much like to grow the channel, and we can only do that with your help. So I will catch you all again